Hello everyone, and welcome to today's episode where we will unfold investment vehicles that exist in the world, ranging from the top choices for poor all the way down to ultra wealthy and wealthy kind of choices. Let's get into it. So essentially we are going to cover CDs, HYSA or high yield savings accounts, T-bills or bonds, both governmental and corporate. Then we're going to cover ETFs, index funds, investment funds, private credit, private equity, venture capital, and commercial banks. So the bottom of investment food pyramid would be HYSA or high yield savings account that originally can produce somewhere between 3.5 to 5% of the annual return. The great point is that there is no limit for entry and you can withdraw your funds anytime. Nuances is that 3.5% of an annual return is not really that attractive. Then we have T-bills. T-bills, treasuries, bonds is all the same thing. Government bonds or government treasury bills. They would be fixed in time. You can buy anything from 4 weeks to 30 years, and respectively the yield on them would vary. It can go all the way from, let's say, 2% or 2.5% for the short-term treasuries, all the way up to 6.5%. However, let's say if the Federal Reserve raises the rates, usually you would see immediately the impact on the longer term or sometimes even shorter term treasuries, because their yields will also go up. Why there is such a level of correlation? Because technically speaking, T-bills is monetary units printed out of thin air. Why there is a perception that it is very safe? Well, that's just because the government can print whatever quantity of monetary units they like. In a credit-based economy and no more a gold standard, they can do whatever monetary emissions they want. And pretty much you can hardly imagine a circumstances where central bank will not be able to print more money. That's why there is a perception that they are very safe. In that regards, they are very safe. And then we have CDs. CDs essentially combine the worst of two first worlds of HYSA and T-bills, because certificate of deposit. So you take your money, you put it to the bank, you lock your money at the bank for specified amount of time, usually at a very unattractive yield of 3.5 to 5%. And there is no way you can withdraw your money without a penalty. Penalty usually would be a several months of your yield. That's in the case you need the money urgently. So it actually combines a low yield and locking your money up for an extended period of time. And unlike bonds or T-bills, that, for example, if you need liquidity urgently, you can just go on the stock market and trade it and sell it any trading day. Where it pertains to CD, sign up for it and you have to wait for at least a year, usually all the way sometimes up to 5 years, until it matures with your bank. You find very limited appeal in CDs and motivation for anyone to use them. However, CDs, high yield savings accounts, and treasury bills are the most advertised for lower income demographics. In a number of cases, because of a low entry points. So in a number of cases, you can open CD or HYSA or even buy T-bills for all the way down to $1,000, which is fairly accessible. Moving on to index funds. They have to mirror the objective of that particular index fund. So for example, if we take S&P 500, all they need to do is that they need the managers every single day at the end of a previous trading day, they would need to buy a certain allocation of the specified company's stocks and rebalance the basket of all the companies that should be part of that index fund. Also, there are index funds for commodities, etc., and so on and so forth, and their principle is always exact same. In the case some stock goes up substantially, then managers the very next day, they are going to buy more of that stock. In the case it goes down, they will be selling. Passive index funds held over a prolonged period of time for like 20-30 years, they can be fairly well performing, I would say. However, I would like to point out here such an important thing as an inflation. So we have covered T-bills. Every single time a government needs to issue T-bills and then pay the percentage, the coupon on that T-bill, what they do, they print money. When government print money, inflation goes up. That's why in a number of cases, T-bills, they would only cover inflation, and in some cases they will not even do that. HYSA and CDs is off the charts. They do not even cover the inflation. So when it comes to index funds, they can outperform inflation by a little bit, usually 1, 2, 3, 5 percentage points if you are exceptionally lucky. But then you have an alternative to passive index funds. You have ETFs. ETFs is a slightly different animal, and it can be active or passive. You have passive ETFs for pretty much anything you can imagine right now in an investment world. You can have ETFs for T-bills. You can have ETFs for index funds. But more importantly, what is the difference between index funds and ETFs is that ETF can have a certain profile, such as it can be energy, or it can be nuclear, or it can be metals, or it can be rare earth metals. So it usually would have some certain profile to it, and it will be managed by portfolio managers. But there is a caveat to it that you should always pay attention to when you consider buying ETFs. Management cost of ETF, depending on what that particular ETF does, can be anything from very cheap ones, I would say 20 tips. In some cases, it can go all the way up to 1.5%. This is something you need to price in at the time of your position opening. And then you want to consider the dividends that that ETF is paying. Dividends may vary, obviously, and usually the situation you would observe is that companies that are part of that ETF are essentially paying higher dividend yields by themselves versus what you would receive from the ETF. Reason being, well, they need to make money. This is business after all. Finally, Lately, we had a lot of interest towards called income ETFs that would operate not just the indices or some specified profile of equities. They would operate equity derivatives such as call options, put options, and all the modifications and the variations of this too. Which means also that in a number of cases, the upside offered by those trades can be borderline unlimited, but there is also need to be considered the fact that there is a capital erosion. So if you will find an ETF that is paying you 50 to 100% of a yield, there might be a substantial capital erosion of your principal that you have paid at the time of the ETF purchasing. The reason why this is happening is because if you trade options as an asset manager, chances are not 100% of your trades would be positive, and sometimes they're gonna lose money, and when they lose money, they decay the capital. So it's not good, it's not bad, it's just something that you need to consider at the time of position opening. Investment funds largely make their money on fees. For example, if you have a company and you want to go public, you want to do an IPO, investment fund is going to help you. It's going to help you to do mergers and acquisitions and so on and so forth. So obviously their job is to generate income for their investors. However, most of their revenue they generate from fees. Unlike hedge funds is another very interesting animal. Their only job is to outperform the market. So for example, if you have Nasdaq moving 35% within a year, a job of hedge fund managers, their only job is to outperform that 35% by as much as possible. Same goes for S&P and so on and so forth. And taking into consideration the fact that usually people who are using services of hedge funds are fairly well off and they can be fairly sophisticated as the investors in the first place, set the bar for hedge funds managers to go above and beyond in the process of making money. And that's why hedge funds are the primary users of very interesting combinations in options trading, insider information, all sorts of this kind of things. Private credit. Another investment vehicle that usually is being utilized by the companies who are not able to get a regular loan from a commercial bank. So for example, remember we have started with CDs. Let's assume you own a commercial bank and at some point in time enough CDs have been allocated in your bank deposits, then you get some extra from National Bank, and this is when a Joe comes to you and say, hey, I would like to have a loan. But turns out that Joe's company is not only not listed on any stock exchange, which also means it has never been really audited by any respectable company, and it costs what the Joe says it costs. But also the risk profile of a Joe and the business model raises some questions, I would say. So you say, Joe, I'm sorry, but unfortunately I cannot give you a loan at possibly 6%. However, you can go to private and take the loan. It's going to be a little bit more expensive, maybe like closer towards 10%, but you can have it. And then the entity, so-called, not a bank entity, but we also call it a shadow banking, because entity that lends money to Joe is acting like a bank, looks like a bank, talks like a bank, but is not bank in terms of their obligations towards the central bank. And of course, that shadow bank will ask all the possible investors around if you would like to invest 10K onwards for 10% up in Joe's new business. The fun part is that in a number of cases, commercial banks will have equity supply capital to shadow bank. This is where it gets really interesting. And also you cannot really blame them, because the primary reason they do it is because they need money at first, and second, they know that most probably central bank is going to back them out. Okay? So that was private credit, which is largely different from private equity. What kind of investment vehicle that is? Let's assume you have $250,000 sitting on your sidelines, and you come to a private equity company and say, look, I'm happy to keep this money with you for the next 5 years, let's say. We're gonna lock that capital. Want at least maybe like 50, 300%. The equity company says, fine. What happens is, private equity company will buy another company. They will do some sort of process optimization, innovation management, and so on and so forth. In a number of cases, they will just fire people, cook the books, and offload all the investors that own that company that will be sold, and nonetheless will need to pay for the private equity bump up. And the investor will get their capital and the capital appreciation back in approximately 5 to 7 years. Nuances that for 5 or 7 years, that investor would need to live off their other investments or other income streams, because this money, they will be capped. If you ask my personal opinion, pretty much as a CD, but with much better yield. Venture capital usually would invest into startups. Certainly some substantial portion of startups would fail for a variety of reasons. Official data would say that approximately 75% of startups would fail within the first 3 years, even after the venture capital investing. But venture capital is a mix of the risk management, which is very interesting, because let's say you have 10 million of disposable investments that you would like to allocate towards 20 or 50 promising startups. So you choose those that sounds most reasonably ones, wait for some time, and support their ventures with the capital influxes in stages and see what sticks. But the beauty of venture capital is that this is where essentially you can have that multi-X growth. This is where you can have 10X, 50X, and that's kind of more of average values as a return on your capital. And plus, at some point, it is also very interesting to meet young and ambitious startuppers and have a feeling that you are being part of the world of tomorrow. Mutual funds originally they combine the worst models of all, if you think of it, because mutual funds, they are being actively managed by people usually who were not good enough for hedge funds and investment banking. Mutual funds have high fees because they're actively managed and there is a lot of frequency trading. Taxes usually do not make sense. You have certain limitations towards what they can invest and they cannot invest. And on top of everything, in a number of cases, you have a certain limitations for the capital withdrawal. And all this for 5 to 6% of annual yield. And also you have pension funds. I understand that many people use them, and overall it is an important system grading investment vehicle, but not the most efficient one. And diamond on this pyramid would be commercial banks. But the commercial banks you open when you already gone all the way up of this pyramid of investment vehicles. And when you have enough capital allocated and enough of your operational needs, where you would consider opening not very popular, highly privately owned commercial bank of your own. Okay, I hope you found this video interesting and educational. I appreciate you watching, and I'll see you the next time.